Michael, welcome. Good to have you with us.
Thank you. Thanks for being here.
You have a somewhat more dour estimate, I would say, of the economy and the market than some of your peers. Why do you feel defensive positioning is the right place to be right now?
I think what we're seeing, traditionally, there's a few factors. Obviously, we see the economy slowing. I see names like McDonald's, for example, a great company. They actually reported, a decline year over year in third quarter earnings. Costco, things like that. So the consumer scares me a little bit, as the previous segment mentioned. You're seeing, credit card levels at very, very high levels, cash savings at super low. So the consumer to me is stretched. So I think that's concerning. The Fed raising rates, restricting liquidity, that typically is not a recipe for increasing in profits. So, it's not that we're negative on everything, but there's certainly sectors now that we look for transparency. And there's a lot of sectors that concern me with what's going to happen in the future with the earnings.
You point out that in 2 years, inflation went from 0.6% to 9.1%, and you don't expect that to reverse in quick order. But so what if the rate stays higher longer? Is that information, is that news that's already sort of being digested in the markets? Why do you think that we should be bracing for more bad news, Michael?
Well, I think part of the issue is I look at the Fed's ability to manage this process. If you looked a year ago at Fed notes, when inflation was about 4.9%, they expected it to be 2%, right now. It got to 8% by the September time. So my concern is their ability to navigate this, and that's going forward. I think we're in a disinflationary environment. I think we saw inflation, the height at 9.1. I think it continues to go lower. I just think it takes a lot longer to get there than people are anticipating. I think people want this to be over fast. Well, they're going to raise some rates, and hey, they'll be cutting rates in the back half of the year. I just don't see that. I think they're going to come lower with inflation, but I think it's going to take a couple rates to get there, and I think they're going to be higher for longer. That's what I really took from Powell's speech the other day. Is it's going to be stubbornly high. We're going to be here for a while. It will drift lower, but it's certainly not going to get to a Fed target rate anytime soon.
Talk to me a little bit about one of the derivatives of the market we've had this year, and that is that cash is no longer trash, and you can actually make a decent yield on treasuries, on some CDs, and other forms of very, very conservative fixed income. So should that portion of an average investor's portfolio be expanded just a bit, given your viewpoint?
Absolutely. You hit it on the head. For years, we've had no rate basically to get. Cash was trash. Nobody got paid. And now all of a sudden you're looking at, a year CDs, all of them are north of 4, treasuries, 2 years or 4.5. So I think that's a strong component for people when we're in this kind of unclear period of time. Nobody needs to be a hero trying to pick a bottom. There's a lot of uncertainty with the market, a lot of opaqueness surrounding earnings. So it makes sense to put more money into CDs, kind of dollar cost average back into equities over time. Again, be selective. But for the first time in a long time, there is an alternative to equities. And for the longest time, when cash paid you zero, it was tough to argue that you can go get a dividend stock and get paid.
And would you ladder maturities here? I assume that's the smartest way to go.
Yeah, I'm looking basically, we've been doing that for clients, basically from 3 months to about a year, 15 months. Mm-hmm. Anything longer than that seems to be kind of problematic in terms of getting that return. But that's where that makes some sense. And we've kind of kept that now as a component of a fixed income portfolio.
There you look at a 3-month T-bill there at 4.3%. That's about as sure a return as you can get. Michael, thank you. Have a great weekend.
Thanks, you too.
All right,
appreciate
bye-bye.
it.